Number 1. Market panic. What's up, guys? It's Graham here. The market is showing unusual panic. Many fear an AI bubble is forming and job losses are at the fastest pace since 2003. Even Michael Burr has exited the market. Number 2. Concentration. The top 10 companies now control 42% of the S&P 500, while the bottom 50% are negative for the year. Even top traders like Nancy Pelosi plan to retire by 2027. Number 3. Proven strategies exist. Despite the chaos, proven strategies exist to make money in any market, unknown to most investors. These next 10 minutes could be the difference between missing out and getting rich. Number 4. Common investor mistakes. Many investors lose money even in profitable funds. The Mellon Fund, led by Peter Lynch from 1977-1990, returned 29% annually, yet average investors lost due to buying high and selling low. Number 5. Don't time the market. Even funds that beat the market can fail their investors. Warren Buffett proves long-term consistency beats chasing short-term gains. Number 6. Short-term outliers. Short-term outliers like Cathie Wood may outperform temporarily, but long-term, patience pays off. Michael Burr's fund shutdown shows timing mistakes can be costly. Number 7. Market return misconceptions. Average market returns of 10% are rare. Statistically, returns between 5 to 15% happen only 18% of the time in a single year. Number 8. Long-term perspective. Investing requires a multi-decade perspective. Over 30-year periods, the S&P 500 averaged 8 to 13.6%, showing why patience is crucial. Number 9. All-weather portfolio intro. Worried about bubbles or crashes? Ray Dalio's all-weather portfolio is designed to profit in any market using stocks, bonds, and commodities. Number 10. 4 economic cycles. Dalio identifies 4 economic cycles: rising, falling prices, and growth. Each cycle has a top-performing asset, making the portfolio resilient. Thanks for watching. Subscribe to Finance Investor Lab for more investing guidance, stock analysis, and wealth-building videos.